Today, we're going to talk about fees, costs, charges, commissions, and ways that Wall Street is making money off of you. Now, one thing you need to ask yourself at all times in the marketplace is how is this institution, organization, or business making money? I bring this up as Robinhood is a great example. It's been a very popular trading app. It exploded in popularity during COVID with more accounts open than Charles Schwab by the end of the pandemic. Be it their accounts are significantly smaller than what's custodianed at Charles Schwab, but nonetheless, they have that many accounts open. And I bring this up is there's this perception that free is good. Low charges, low costs are good. If I'm avoiding fees and costs, that is always good for me. And I'm here to tell you that there is a cost to free. Nothing in life is free. And if it is free, you need to double check and figure out why. A great example of this is Facebook, LinkedIn, Instagram, Twitter. These are all just marketing platforms. They're gathering very detailed information about you and more or less structuring content to capture your attention and sell your attention on an ongoing basis. And you may be entertained by this and have nothing wrong with that. And I'm not here to demonize it. But when it comes to the investment world, some of these free trading apps are front running your trades. Go Google that. What is front running? They're selling your information to high frequency traders. They're making money on cash that's sitting in your brokerage account, lending it out, parking it overnight federal funds rate, putting it in short-term treasuries, paying you a lower interest than they're earning somewhere else. They may even be a bank, which, for example, Charles Schwab or SoFi is an explicit example of that. These are more banking institutions than they are financial institutions. As a significant portion of their earnings, in Charles Schwab's case, it's over 35%, are come literally from banking-like transactions and the excess interest they're earning on the sweep sitting in their brokerage accounts. So I bring this up as one of the big pushbacks I get from new investors, people that are this is their first time having money, is they're very concerned about fees. Should I get this ETF that's 10 basis points or this one that's 20 basis points? Why wouldn't I go with the one with 10 all day? And the reason for that is value. There's this perception that all investments are the same, all ETFs and mutual funds are the same. The returns are basically going to be the same, so we should just get the cheapest ones that are out there. And that's just not true. That's just not true at all. What you're doing when you buy an ETF, index fund, or mutual fund is you're getting a collection of investments. And some of these investments are packaged to emulate a benchmark. And how they emulate that benchmark might be substantially different than how someone else emulates a benchmark. The way they trade, what derivatives they use, how much cash has to be on hand, how much of your money that you're giving them is actually going to go into a direct replica of the benchmark or the purpose in which they stated they're trying to accomplish. Now, you can get very nuanced and invest in sectors that just do real estate or retail. You can just invest in high yield debt. You can just invest in investment grade debt. The possibilities are endless. There's over 8,000 ETFs and index funds and over 7,000 mutual funds at the time of making this video. And just think about how difficult it is to go through 7,000 options of anything. I mean, Amazon can just overwhelm you. You go to find a AAA battery and there's like 5,000 versions of a AAA battery. Do you think what's curated on Amazon is in your best interest, is the best battery or the most profitable battery? Do you think what's on Google is going to be optimized for you? I bring this up as we're getting to inflection points where only a handful of institutions have literally 20 to 40% of investable assets, and they're deploying them in the exact same way to the point where it may be even making markets inefficient. So when you dive into the processes of the ETFs or mutual funds that you're buying, you need to read the prospectus. You need to look and understand how they're making their decisions. It's kind of like if you gave two contractors, hey, here's the plans for my house. They're going to build a little bit differently. They may even use different materials. And the second, third order actions for the quality, the ongoing cost and maintenance, as well as the initial cost could be substantially different. So I hope you found this video helpful. When you look to shop for your investments, we highly recommend working with a professional investment advisor and maybe even hiring a professional investment team to manage your money. For most people, it's just not worth their time, effort, energy, attention. And if you make one mistake, it's going to more than make up for the fee that a professional investor could help you avoid that same mistake. Until next time, my name is Kit Lancaster, Certified Financial Planner at Sterling Edge Financial. My job is to challenge you and help you make more informed financial decisions. by implementing processes, methodologies that serve your financial plan, very specific to you. Until next time, take care.